In 2026, mortgage rates are still in the mid 6% range.
What?
Prices are barely growing nationwide, and some boom markets are starting to crack while others quietly get stronger. Let's start with the big picture. Many analysts aren't calling 2026 a repeat of 2021 or 2008. They're calling it the beginning of a new era for the U.S. housing market.
That's right.
According to reporting from Newsweek, real estate analyst Nick Gurley says 2026 will solidify a sharp regional divide that's already underway. Some markets are cooling or even seeing price declines, while others keep grinding higher because they're still relatively affordable for local incomes. At the same time, Redfin describes 2026 as part of a great housing reset, where instead of wild swings in prices, rates, and demand, the market slowly rebalances. Here's what that new era looks like in actual numbers.
I don't know, you tell me.
Redfin expects the median U.S. home sale price to rise about 1% in 2026, not crash, and they expect existing home sales to increase around 3%, to roughly 4.2 million sales a year. J.P. Morgan's outlook sees national home prices basically stalling at 0% growth in 2026, looking more flat than freefall. So the headline for 2026 is not housing collapse. It's a slow, uneven reset that creates winners and losers depending on where and how you buy. Let's talk about the downside first, because there are some real reasons 2026 could be a terrible year to buy, especially if you assume reset means cheap. Mortgage rates are better, but still painful. Forecasts from Redfin and other outlets point to average 30-year mortgage rates sitting in the mid 6% range in 2026, around 6.3%. That's lower than the roughly 6.8% we saw in the spring of 2025, but it's still much higher than the 3 to 4% rates people locked in during the pandemic boom. Here's what that means for you. Your monthly payment on the same priced home is still significantly higher than it would have been a few years ago. And if you're stretching your budget, a 6+% rate can lock you into a payment that leaves very little room for savings or emergencies.
Stan, now more than ever, you need to understand the importance of saving money.
So if you're expecting mortgage rates to go back to normal, just know that 3% probably isn't normal anymore. Prices are cooling, not crashing. A lot of buyers are sitting on the sidelines waiting for a big price crash in 2026, but most forecasts say that's unlikely. Redfin's base case is that prices rise about 1% nationally in 2026, while JP Morgan's base case is that prices basically flatten around 0% growth. And other forecasts collected by financial outlets also point to cooling, not collapsing prices. So if your strategy is, I'll buy when homes are 20 to 30% cheaper, 2026 could actually be one of the worst years to jump in, because you're still paying near peak prices in many areas, you're still dealing with elevated mortgage rates, and you may be locking in at a moment when price growth is slow, not negative. That combination can lead to very weak short-term returns if you have to sell within just a few years. Then there's the Sunbelt hangover and those risky markets. This new era isn't spread evenly across the country. Newsweek reports that some of the big pandemic winners, Sunbelt markets such as parts of Florida, Texas, Austin, and Nashville
is back.
are now facing a very different reality. In those overheated areas, builders put up a ton of new homes during the boom, so inventory is now rising. Demand has cooled as remote work fades and return-to-office policies pull some people back to higher-cost states. In some of these markets, the mortgage cost-to-income ratio has climbed above 35%, historically a red flag for affordability and demand. On top of that, relistings nationally have climbed to their highest level in a decade, which means more homes aren't selling the first time and are coming back on the market with price cuts or better terms. Buying into a market with growing inventory, softening demand, and stretched affordability can expose you to short-term price declines, longer days on market if you need to sell, and a higher chance that your home underperforms the national average. For those areas, 2026 might be the worst time to buy if you're treating it like a guaranteed bottom.
Yeah, I said it.
There's also economic uncertainty and job risk to think about. Redfin calls out a weaker job market, especially the impact of AI on white-collar work. as a factor that will keep some buyers on the sidelines.
Chat GPT, dude.
Even if affordability technically improves a bit, people worried about layoffs or unstable income may be hesitant to buy. If you buy at the edge of your budget and your job situation changes, a 6+% mortgage can go from manageable to quote overwhelming really fast. So if your job or income is shaky, 2026 can be a rough time to take on a big, inflexible monthly payment. Now, let's flip the coin, because for the right buyer in the right market, 2026 might actually be the best opportunity you've had in years. Affordability finally starts to move in your favor. Here's the key shift. Redfin expects wages to grow faster than home prices in 2026, and that would be the first sustained stretch like that since just after the 2008 housing crash. Their projections line up like this. Home prices up around 1% nationally, mortgage rates down from 2025 levels, closer to 6.3 instead of 6.8, and monthly housing payments that grow slower than wages. That combination nudges affordability slightly back toward buyers, even if it doesn't feel like a deal in absolute terms. If your income has been rising while you've been waiting on the sidelines, 2026 might be the year where the debt-to-income math finally works. Buyers also regain some negotiating power. The era of waiving every contingency and offering $50,000 over list price on day one is fading in many markets.
They call me the Grim Realtor. I like to have fun with my material.
Several data points point to a more buyer-friendly landscape. Sellers are starting to outnumber buyers in some areas. Price cuts and concessions are becoming more common, and builders are offering incentives like rate buydowns to move their inventory. For you, that can mean more room to negotiate on price, closing cost credits, rate buydowns, or repair concessions, and the ability to keep inspection and appraisal contingencies in place rather than going in blind. If you're a patient buyer who's willing to walk away, 2026 gives you more leverage than you've had in a long time. Not all markets are softening either. Newsweek points out that many Rust Belt and some Northeast cities, places like Cleveland, Hartford, Albany, Chicago, and parts of the Midwest, still have relatively tight inventory and remain more affordable for locals. In these areas, mortgage cost-to-income ratios have climbed from around 20% to about 30%, which is more expensive than before, but still within a range where many households can qualify for mortgages. That supports ongoing sustainable demand and continued price growth, even while other regions stall. Analysts expect reverse pandemic migration, where people leave expensive Sunbelt boomtowns and return to more affordable legacy markets to continue for several years. So if you're buying in a structurally affordable, job-stable market, 2026 might actually be a great entry point before more buyers show up. Inventory is also slowly improving. We're finally seeing something buyers have been begging for. More homes to choose from. National inventory has been rising from its extreme lows, with relistings at decade highs. Major banks estimate the housing shortage at around 1.2 million homes. Still a gap, but smaller than many thought, and recent supply growth is helping cool prices. Industry groups expect slight increases in both existing and new home sales in 2026, implying more options for buyers. More homes on the market mean less competition per listing, more ability to compare and be picky, and less pressure to make a rushed decision. If you've spent the last few years losing bidding wars, that shift alone can make 2026 feel like a breath of fresh air.
I don't think it's a competition. Let's not make it a competition.
So how do you figure out whether 2026 is your worst year to buy or your best? You can break it down into 3 simple filters: your market, your money, and your timeline. First, your market. Overheated versus under the radar. Ask yourself if your market has seen explosive growth since 2020 with big run-ups in price, lots of new construction, and tons of inbound migration. Think parts of Florida, Texas, and those Zoom towns that blew up during remote work. Or if your market is more of a slow and steady Rust Belt, Midwest, or Northeast city where prices rose but not insanely and inventory is still relatively tight. If you're in an overheated Sun Belt or West Coast boom market with rising inventory and softening prices, consider being extra conservative on the price you're willing to pay. focusing on homes you can hold for 7 to 10 years, not 2 or 3, and negotiating hard because you may be one of fewer serious buyers out there. If you're in an affordable, job-stable market with solid demand and limited supply, 2026 could be a great time to buy before more people rediscover your area. Next is your money, stretching versus comfortable. Be brutally honest about your budget. With mortgage rates in the mid-6% range, your monthly payment will still be high compared with the pre-pandemic era, and even if the national data says affordability is improving, that doesn't help if your personal numbers are tight. Run the payment using a realistic rate, around 6.3 to 6.5%, and make sure your total monthly housing costs, including mortgage, taxes, insurance, and HOA, still leave room for savings and an emergency fund. If the only way 2026 works is by hoping for lower rates later or hoping for big income jumps, it might be your worst year to buy. If you can buy comfortably at today's prices and rates, without betting on a future refinance, it could be one of your best.
So, this week, meeting up with the realtor, checking out some locations. I'm pretty excited about it, to say the least.
Finally, your timeline. Short-term versus long-term. Most forecasts for 2026 are pretty meh. Small price gains, flat to modestly better sales, and still elevated mortgage rates. That means if you plan to sell in 2 to 3 years, there's a real chance you don't see much price appreciation after closing costs. But if you plan to own for 7 to 10 years or more, modest early growth matters way less than long-term fundamentals. Long-term buyers who choose a solid, diversified local economy, avoid massively overheated micromarkets, and buy a home they can actually afford are much more likely to look back on 2026 as a good entry point, especially if wages keep outpacing prices for a few years. Either way, the key is to stop thinking about the national housing market as one big story. In this new era, your outcome in 2026 depends way more on your zip code and your personal numbers than on any headline. If you want more no-hype, data-driven breakdowns of the housing market,
Please like and subscribe.
subscribe to at Housing IQ so you don't miss our next deep dive.
Be sure to subscribe to my channel if you haven't already, because subscribing makes you feel good.